Vanakkam. Welcome to this short video on service concession agreements covered in Ind AS 115 corresponding to IFRS 15. In this video, we will be looking at some of the examples given in IFRIC 12 from a CA final exam perspective. You may have already gone through illustration 75 of your study material. If you have not already gone through this illustration, please go through the same before watching the rest of this video. The illustrative examples which we are going to see are a more detailed version of illustration 75, you could say. In illustration 75, the information is given in the question and all the student has to do is to pass journal entries. And illustration 75 covers two cases. The first case, the government guarantees a cash flow, so it's a financial asset. And in the second case, the government transfers the right to collect toll from the users, which is an intangible asset. So we will be seeing both these cases in the illustrative example, and there is also a case where it is partly a financial asset and partly an intangible asset. So let's now jump in to the illustrative example 1 of IFRIC 12. Now this is question 15 for students who are attending the regular classes. The illustrative example is more in the form of an explanation, so it has been adapted in a more student-friendly manner. So let's read this question. The terms of the arrangement require an operator to construct a road, completing construction within 2 years, and maintain and operate the road to a specified standard for 8 years, that is, from the years 3 to 10. So construction is over within 2 years, and then the operator operates the road in years 3 to 10. The terms of the arrangement also require the operator to resurface the road at the end of year 8. So construction costs incurred in years 1 and 2, operating costs years 3 to 10, and resurfacing costs end of year 8. At the end of year 10, the arrangement will end. Assume that the operator identifies 3 performance obligations for construction services, operation services, and road resurfacing. The operator estimates that the costs it will incur to fulfill its obligations will be construction services in year 1, 500 currency units, year 2, 500 currency units, operation services per year, years 3 to 10, 10 currency units, road resurfacing in year 8, 100 currency units. So this currency units is a general term that is used in many IFRS publications. Rather than using a specific currency, they sometimes use currency unit. So you can very well take it as rupees. Moving on. The terms of the arrangement require the grantor to pay the operator 200 currency units per year in years 3 to 10 for making the road available to the public. Assume that all cash flows take place at the end of the year. Now, what are the costs that the operator incurs? Construction costs, operation costs, and road resurfacing costs. So costs are incurred at the end of every year, year 1, 2, 3 up to 10, and additional cost at the end of year 8. So costs are incurred every year from year 1 to year 10. But the grantor will pay the operator only in the years 3 to 10. It doesn't pay the operator anything in years 1 and 2. So the currency units of 200 per year payable in years 3 to 10 is nothing but the promised consideration promised by the grantor. It needs to be examined whether there is a significant financing component. Let's read on. The operator estimates the relative standalone selling price as follows. Construction services, forecast cost plus 5%. Operation services, forecast cost plus 20%. Road resurfacing, forecast cost plus 10%. So the cost is given in this table. So a markup is added to these costs to give the relative standalone selling price. The implied interest rate, that is the rate that would be reflected in a financing transaction between the operator and the grantor, is 6.18%. The operator finances the arrangement only with debt and retained profits. Pays interest at 6.7% per year on outstanding debt. Before we proceed with analyzing whether there is a significant financing component, there is a finer point to be discussed. So what is this standalone selling price? As per para 77, standalone selling price is the price at which an entity would sell a promised good or service separately to a customer. So standalone selling price need not be the cash selling price. So cash selling price is the price at which you would sell for immediate cash. Standalone selling price is a price at which entity would sell a promised good or service separately to a customer. So here there are three performance obligations. So when you sell all three together, there could be a discount. If you were to transfer those services separately, what would be the price? That is the standalone selling price. But in order to examine whether there is a significant financing component, what do we need? We need to adjust the promised amount of consideration for the effects of time value of money. And for that, as per para 61, we should take the amount that reflects the price that a customer would have paid for the promised goods or services if the customer had paid cash. In other words, the promised consideration may have to be adjusted to the cash selling price if there is a significant financing component. So in other words, for significant financing component, we need promised consideration and we need cash selling price. So in this question, what is given is only standalone selling price. So due to lack of information, we will make an assumption that this standalone selling price is the cash selling price for the purpose of determining whether there is a significant financing component. When we allocate the transaction price, we need the relative standalone selling price, right? So the total transaction price may be X amount that has to be allocated to these three services in the ratio of their relative standalone selling prices. That is as per para 74, that the transaction price has to be allocated on a relative standalone selling price basis. So let's jump to the solution now. The promised consideration, that is 200 per annum into 8 years, comes to 1600. The question now appears in the bottom panel for your reference. So the construction cost is given in the question. To calculate the standalone selling price, we add the markup that is given in the question at the bottom panel. This is the standalone selling price. As explained, standalone selling price is assumed as the cash selling price. In order to determine whether there is a significant financing component, we need to consider all relevant facts and circumstances, including the difference between the promised consideration and the cash selling price, and the combined effect of the expected length of time when the entity transfers the promised goods or services, when the customer pays, and the prevailing interest rates in the relevant market. It is the market interest rate. So what is the difference between promised consideration and cash selling price? That is 1600 minus 1256, that comes to 344, which is 27% of the cash selling price. When you analyze the length of time between when the entity transfers the promised service and when the customer pays, here the customer is the grantor. So construction services are transferred by the end of years 1 and 2, but payment for that is received in years 3 to 10. For operation services, there is no lag, because as and when you perform, that is, you operate the road, you incur the operating costs, you receive payment. So a part of that 200 per year would include a sum for the operation costs also. And the resurfacing costs also, there is a time lag. We incur the cost at the end of year 8, but payment is received in years 3 to 10. So construction and resurfacing, there is a difference in payment, and they are the major part of the expenditure and the activity. So therefore, as per para 61A and para 61B clause 1, we can conclude that there is a significant financing component. Prevailing market rate is not given, so we can't use that for our analysis. So let's move on with the question. What is required is the transaction price allocated to each performance obligation. Let us quickly summarize the steps to be followed to do the same. So these are some of the abbreviations that we'll be using in this flowchart. So first we calculate the promised consideration, then we check whether there is a significant financing component. If yes, we need to adjust the promised consideration for the significant financing component, and the transaction price becomes the adjusted promised consideration. If there is no significant financing component, then the transaction price is straight away the promised consideration. Once we have found the transaction price, we then allocate it in the ratio of the relative standalone selling price. This is the approach to be followed for this question. So what have we done so far in this question? We have calculated the promised consideration, right? You can refer the video panel on the top right corner of your screen. So we have calculated the promised consideration. Then we have determined that there is a significant financing component. We have also calculated the standalone selling price. Now what we need to do is we need to adjust the promised consideration. How are we going to adjust the promised consideration? That's what we're going to see now. So we have to find present value of the promised consideration using either, now this is as per para 64. We will be applying the relevant provision for this question. So as per para 64, you have to adjust the promised consideration by finding its present value using the discount rate that would be reflected in a separate financing transaction and reflects the credit characteristics, collateral or security provided. Or we have to use the rate that discounts the nominal amount of the promised consideration to the cash selling price. If you use the second rate, then the adjusted promised consideration will be equal to the cash selling price. So applying the provision to this question, what does this point A mean? If the operator were to give a loan to the grantor, what interest rate would be charged? After considering credit characteristics and collateral or security provided. That is what point A is. The second rate that can be used is basically the implied interest rate. Coming back to the question, what is given? The implied interest rate, that is the rate that would be reflected in a financing transaction between operator and grantor. So in this question, both the rates are one and the same. So our calculations are going to be very simple. If you use 6.18% to find present value of the promised consideration, what is it going to equal? It should equal the cash selling price, which is nothing but the standalone selling price, and that is already allocated to the performance obligations. So nothing further needs to be done. So answer to subdivision A, standalone selling price is the transaction price allocated to each performance obligation after adjusting for the significant financing component. Now just a note for your reference, suppose there was no significant financing component, then what would we do? This 1600 would be treated as the transaction price, and that would have to be allocated in 1050:96:110 ratio. So this note is just for the reference of the student, or student note, does not form part of the answer. Next subdivision of the question, debt and borrowing cost for all the years. So it is given that the operator finances the arrangement wholly with debt and retained profits. It pays interest at 6.7%. So what are the cash flows? They are the construction costs. Year 1 and 2 it is 500. Operation costs 10 per annum. Road resurfacing at the end of year 8 it is 100. These are all the outflows. What are the inflows? Inflows are only this 200 currency units per year for years 3 to 10. So that has what has come in this calculation. So you have contract costs and you have receipts. So they are all at the end of each year. So at the end of the first year you incur the contract cost, and then you calculate at 6.7% on the opening balance. You have contract cost at the end of the year again. So this is the closing balance, and then you repeat the process. So the receipt you minus. So that is how you calculate the debt for all the years. In year 10 alone there is a surplus. So in fact there is a net cash instead of debt. So all these values will come in the balance sheet extract, which has been asked in the last subdivision. Third subdivision, they've asked us to calculate the contract asset or receivable and finance income for all the years. So what is due from the grantor for construction services? It is forecast cost plus 5%, which we have calculated as 1050. When should 1050 be recognized as revenue? It should be recognized over years 1 and 2. Similarly, 96 should be recognized over 8 years and 110 at the end of the 8th year. So that is what has come in this due column. So 1050 by 2, 525, and then 12, and then in the 8th year plus 110. So first year 525 is due and recognized as income. That is at the end of first year. It becomes the opening balance of the financial asset. Then at 6.18% we calculate the finance income. So closing balance will be opening plus finance income plus due. From the third year onwards, we are receiving installments, so that is subtracted. And for the last year, the finance income is the balancing figure, adjusting the rounding of difference. The last remaining subdivisions, journal entries and P&L balance sheet extract. So in the interest of time, journal entries for all years have been passed together. The first column represents journal entries for year 1, second column for year 2, and so on. So journal entries can very easily be passed from the tables we have just prepared. The table in subdivision B will give all the entries for costs. So for first year, it will be construction cost to bank. Here, since it is a borrowing, we are going to be passing construction cost debit to borrowing, 500. And then there is revenue that is recognized. That is receivable from the grantor. That's a financial asset. So financial asset to contract revenue, 525. Then in the second year, we recognize borrowing cost. So borrowing cost debit to borrowing, 33.5. Again, construction cost to borrowing, 500. Here it will be financial asset to finance income, 32.44. Financial asset to contract revenue, 525. Then for the third year, the other entries get repeated. There is an additional entry for the receipt. So this affects both the borrowing and the financial asset. The journal entry is basically bank account to financial asset. Instead of bank account debit, we are using borrowing account debit. Borrowing account debit to financial asset, 200. So from these two tables, all the journal entries can be passed. We just change the head for years 3 and also for year 8 for the costs. So it becomes operating cost to borrowing, resurfacing cost to borrowing. And then the last subdivision is the P&L and balance sheet extract. For the P&L extract, you may use the journal entries, and for the balance sheet extract, you may use the two tables. You may take the closing balances. So to quickly sum up this question, we first calculate promised consideration, then we calculate the standalone selling price by applying the markup to the forecast costs. Then we need to determine whether there is a significant financing component. We compare the promised consideration with the standalone selling price, which we have assumed as the cash selling price. There is a significant difference. There is also a difference in the timing, when the amount is due and when it is paid by the grantor. Market interest rate is not given. So based on just these two factors, we can conclude that there is a significant financing component. We need to adjust the promised consideration. How do we do that? Very simple. Since implied interest rate is to be taken, the cash selling price or the standalone selling price becomes the adjusted transaction price. It's already allocated. So our calculations have become very simple. Then we calculate the debt and borrowing cost, financial asset and finance income. So for debt, we think in terms of cash flows, how much we are paying and how much we are receiving. We apply 6.7% interest. And for financial asset, what is promised by the grantor, that is the revenue that we are recognizing, and when we are receiving that amount from the grantor. Journal entries we then pass from the two tables we have just prepared. Then for P&L extract, we take the costs and revenues that are there in the journal entries, balance sheet extract, closing balances of the two tables.